So investors, I think, in a bit of an attempt to make economics more understandable to the masses, many financial commentators have over the years tried to reduce pretty complex economic theories into basic shapes, or nowadays a single letter in the alphabet. First, there was the V-shaped economy that was meant to show a steep decline into a recession, but an equally as fast recovery out. Then there was the double dip economy designated by a W, where the economy shrank into recession, began to grow again, slipped back into a brief contraction, only before picking up speed again and on the growth side. Investors, most recently, many in the economics world have introduced a new shape and a new letter into our financial lexicon. That's the letter K. This letter being used to describe an economic recovery where different demographic groups experience different results. Investors, unlike a V-shaped recovery, where theoretically everyone gains equally or at least at the same rate, the K-shaped economy means some areas do well and gain, while others suffer and decline, leading to a divergence in wealth and opportunity. In the current K-shaped recovery, the overall GDP of our economy is still growing, currently at 3 to 4%, but it's highly concentrated and fewer workers believe that they are benefiting. Currently, the AI infrastructure build-out is accounting for a very large proportion of incremental GDP growth. That infrastructure spending is helping drive up a number of large-cap tech stocks that are heavyweights in the S&P 500. Investors, at the same time, this CapEx spending is contributing to a continued higher level of prices on energy and materials. At the same time, layoffs at a number of larger tech companies is causing a great deal of job anxiety for college students graduating and those entering the workforce, as well as workers making $100,000 to $250,000 per year who are fearing that AI automation will eventually eliminate their jobs. Investors currently, those individuals with larger stores of wealth, fixed assets like houses and investment assets like stocks might be feeling pretty good about the economy, while many others who don't have savings or don't have larger stores of fixed assets don't. The general idea here seems to be that only the rich and the super rich are doing well in today's economy. They own all the assets. They spend all the money. They get to travel, buy cars and homes, and enjoy life, while many others are struggling. Investors, for the lower and middle income class, K-shaped recovery means that these economic times still remain very difficult. Employment in the hospitality and food service sectors factors heavily for the lower income classes and middle income classes, and clearly, these businesses are struggling under the weight of a weakening consumer spending there due to migrant deportations affecting demand, as well as job insecurity fears. While it's hard to quantify these things in real time, particularly with a lot of missing economic statistics due to the recent government shutdowns, our investment teams reviewed hundreds of earnings conference calls quarterly. Investors, it's really hard to argue against the concept of a K-shaped economic recovery currently when an investor hears one week that foot traffic at a well-known $10 burrito restaurant was flat to down in the late third quarter. But the next week, when listening to conference calls, an investor hears that sales at Cartier and in luxury jewelry were up 17% year over year and up 11% last quarter. Yes, I know the rise in gold and platinum prices does help their results, but those are results after the added cost of import tariffs and into the U.S. So what's this K-shaped dynamic mean for you and your money if you're an investor? It probably means many shoppers are out looking for a deal on price. There are probably more shoppers at Walmart and off-price retailers than you remember a few years ago, and probably fewer at Target. It might mean consumers might have been cutting back on planning next year's vacation or even smaller affordable weekly luxuries like that daily or weekly purchase of a triple foam upside down caramel macchiato. That even those smaller purchases might be pushed out to a monthly splurge, or they might be canceled altogether until one feels more secure about their job and about their future advancement. It might mean that many online resale companies might be doing quite well, as many consumers look to raise a little more cash by selling some of their gently used merchandise in front of a holiday period. From an interest rate perspective and Fed policy perspective, it might mean the Fed is less dovish or less willing to cut interest rates materially over the next year, fearing higher inflation or seeing already high asset prices, which might keep the housing market slower than buyers need or sellers want. With all that said, investors and followers know that regardless of the letter the economy takes or follows over the next few months, our financial planning and advisor teams we'll be here. Until next week, have a blessed weekend, and know the Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.